Welcome to Wealth Roadmap with Jeff and Steve, your guide to simplifying wealth management. Join us as we explore financial planning, taxes, investments, insurance, and legal frameworks to help you secure your financial future. All right, welcome everyone. My name is Jeff Costello. Welcome to the Wealth Roadmap podcast with Jeff and Steve. I am your host along with Steve and Benny. It's been a minute since our last episode, but today is episode 15. We took a little break over the summer. Steve, how was your summer?
My summer was wonderful, Jeff. I took a couple vacations, trying to be like you, out and about. How about yours? I know you were hitting the beach quite a few, that tan, I could tell.
Trying to get Steve Benny's tan, ladies and gentlemen, but it is a tough feat. Tough feat for sure. So, Steve had a lot of fun over the summer. I had a lot of fun over the summer. The next 15 to 20 minutes on this podcast may be fun, may not be fun. We're going to be talking about tax rates. But it's important for you to know how taxes work. We all love our family, but Uncle Sam is a family member that we really don't want to give too much money if we have to. So today we're going to be talking about the basics of how income taxes work, specifically around the marginal tax bracket, what the effective tax rate means, and what tax rates could look like kind of going forward, and why it's so important to kind of plan with the limited time that we do have left before 2026.
I like it. And when you say going, well, you said something when tax rates do change, knowing that they will change as you pull up what you're going to pull up, Jeff. They'll be changing at the end of next year. At the time of this recording, it is 2024, September 16th exactly. But at the end of next year, meaning at the end of 2025, starting in 2026, okay, if Congress does nothing, the tax code will change, does change. The Tax Cuts and Jobs Act sunsets, and then we see, or we go back to how it was in 2017, adjusted for inflation. So, oh yeah, there it is. And that measuring cup, that's the one and only.
So if you're listening to us on Spotify, Apple Podcasts, or wherever it might be, this may be a good time to change maybe to YouTube so you can kind of see the visuals here. But essentially what we have here is shows the 2024 individual income tax rates based off of how much money you make. Being that I am happily and luckily married to my wife, and so is Steve, we're going to focus more on the married side. If you are single, just look on the left side of the measuring cup and you'll see your appropriate figures. But for this podcast, I'm going to focus on the married section. So as you can see, in 2024, we have a standard deduction of $29,200. You get a bonus if you're over age 65. And then anything below $23,200, you're taxed at 10%. Anything below 94,000 and between 23,000, you'll see you're at 12%. You'll see we made this pretty third grader. We have green, we have yellow, and we have red. Green is good. Of course, we'd like to pay 10 or 12%. Red is bad, 37%. Who wants to pay 37%? Now, I'm going to have Steve kind of break down what the marginal tax rates mean, because a lot of times people think that, oh, you know what, Steve, I'm going to make $205,000. That means I have to pay 24% taxes on all of the money I make. And that is not true. We understand taxes can be confusing. So again, today we're hoping to expand on just how it works. So Steve, talk to us about, hey, if I plan on having $205,000 of ordinary income, what is my, walk me through what I'm paying in taxes.
So we'll make some assumptions here. Of course, we'll assume that, yes, let's call it, earned income or ordinary income coming through. So we have 205,000. Well, what did Jeff, you mention? And let's consider us to be under age 65, and let's assume we're going to go ahead and use the standard deduction, right? Obviously, if we used an itemized deduction, if the itemized deductions that we had were more or higher than the standard deduction, we'd be able to use that. But most people, especially because of the Tax Cuts and Jobs Act, that standard deduction has practically doubled. And so most people, it's said to be about 10% of the population is using is actually itemizing. And most are, in fact, taking a standard deduction. So let's call it 205,000. Remember, we have that standard deduction, right? So we're gonna assume for all purposes that we have no deductions above the line, meaning our adjusted gross income is then going to be 205,000. Making these assumptions, these are all hypothetical numbers here as far as income and the scenario that we're presenting. Yes, perfect. We have a simple math problem. We have the deduction of 29,200. Jeff, with his quick math skills, brings it down from 205,000 down. Standard deduction 29,200 brings us to $175,800. Right, so that is the taxable income that we have, $175,800. Now, when we look at the marginal rate, that's, as Jeff was mentioning, kind of detailed here with this measuring cup. The green, good, yellow is okay. But we live in a dynamic pay-as-you-go tax system, right? Not every dollar of income is taxed the same. So we get that standard deduction, and then that next $23,200 of income, again, married filing jointly, you'll see there, that is taxed at 10%. All right, so you kind of would do the math, 10% of that. Then from $23,201 to $94,300, that amount of income is taxed at 12%. And then so forth and so on, from 94,300, greater than 94,300, so 94,301 up to 201,050 is 22%. Now, again, we said that it was after the deduction, it's 175,000. So we're falling into that 22% bracket, but not all of that income is being taxed at 22%, right? Only the overage above that threshold, that income threshold. So looking at this measuring cup, the $94,301 up to $175,800 is taxed at 22%. And then, of course, if you have any additional income, for right now, we're just assuming that this is all the income, but this is where tax management really comes into play, especially if, throughout the year, there's certain things or certain, whether it's you're selling a capital asset or, selling or receiving a bonus, so forth and so on, that could cause you to be able to recognize or assume more income. This is where tax management comes into play, because you want to really figure out what deductions possibly that you could take, that you could take advantage, or alternatively, you may want to, counterintuitively, pay tax. Take the tax hit now. 22% rate marginal isn't necessarily that high historically speaking, and if we're in that 22% marginal rate, that's not the rate. That's our marginal rate. That's not our effective tax rate, right? So simply put, just think of the effective tax rate as what that blended rate would be after the standard deduction. So with the 22% rate, you may be sitting somewhere, I'm making this up, 15%. So meaning that on $175,800, or otherwise said, the $205,000 that you brought in after the deduction, the $205,000, you're really only paying, let's say, 15% on taxes. The question always becomes is, how do you feel about paying 15%? Historically speaking, and again, looking forward, I think that's one big thing that we fail to recognize or fail to see is what's going to happen in the future, right? How are we going to manage the brackets today, knowing what we know, with the understanding of what we're paying in taxes, so that we can make the right decisions this year to maximize our tax brackets? Because if we do believe tax rates will go high, and as we mentioned, this is one of the first times in history that we know taxes are on sale, because we know that the deadline's at the end of next year. If Congress doesn't do anything, boom, taxes go up. We know for a fact if Congress does nothing, taxes go up. So meaning it might make sense to potentially not contribute to your 401k. And if you have a Roth 401k option, maybe potentially, yes, you'll pay more tax on that money today because you're not getting that deduction. I'll go back to that example, Jeff, that you have there. If you have 205,000, and let's say you contributed 10,000 to your 401k, right? In that little math problem that Jeff has, we would subtract 10,000 from 205, and then we of course would subtract the 29,200. So we would reduce our income by another 10,000. But again, this is where really kind of thinking, does it make sense to take that deduction today, especially if your effective rate, and that's why it's important to distinguish between marginal, the tax, the dollar at which, I'm sorry, the highest rate at which your last dollar of income is being taxed at
Yeah.
versus your effective rate. Because maybe you take that 10,000, yeah, maybe you'll pay 22% on that 10,000, but if your overall taxes are still within that kind of 15% range, or a range where you feel that, you know what, I'm okay paying this, because I do know if I put that money and defer taxes today, that money's going to a 401k, when 20, 30, 10 years from now, depending on how old you are, when you have to pull that money out, you're going to have to pay tax on that. Uncle Sam is coming for that money. That 401k is a partnership with the IRS. So I think just looking at it and making sure you have all the facts before you make the decisions, and distinguish between your marginal rate, the effective rate, so that you can make the right decisions now and pull the right levers to get you in the right spot, not only from a investing, but from a tax management side too.
What and if someone was retired, and again, this is their example. They have 205,000 coming in. They get the standard deduction. They have 175 net. This is where we've had a lot of conversations with people of, hey, yeah, you can't contribute to that Roth 401k anymore, but does it make sense for us to do a Roth conversion now? Because anything that you convert between this 175 number and this 201 number is going to be taxed at that 22%, right? And then anything above that, if you wanted to get, if you said, hey, well, 22% is not that much different from 24. Again, well, if we did a bigger Roth conversion, then anything converted from 201 to 383 is taxed at 24%. And like you mentioned, it's kind of forward thinking. Hey, does it make sense for me to pay 24% now, so I can hopefully not have to pay 28% down the road, if tax rates, do increase.
Exactly. And that's the unknown, is where taxes will be. But yeah, I think especially if you're approaching retirement, 5 to 10 years away from retirement, you really want to look at many people have done a very good job at accumulating wealth, and accumulating that wealth in a 401k or these IRAs, these tax deferred accounts that are taxable at distribution.
Yeah.
Uh, that money's got to come out, whether it's now or later. It's coming out, whether it's to you later on in the form of required minimum distributions, or to your beneficiaries upon your passing. And so again, urging it to really to look at that scenario, especially, Jeff, like we had a couple clients where we played it out for them, and we showed the impact of those required minimum distributions and the tax rate that they'd be in the future if they did nothing from those required minimum distributions. And I think that's kind of looking at the full picture.
Yeah, and so like if we kind of like fast forward, right now, again, we're showing you the tax rates, what they are in 2024, 2025. But what happens in 2026 is, if nothing is done, right, we go back to kind of like the old system, the way that the rates were. And so this kind of shows us what we were looking at prior to the Tax Cuts and Jobs Act. And as we can see, right, so 2018, they introduced again the 22% to 24% tax rates. But 2026, this might be going up to 25 and 28%, depending on of course where your income obviously lands. But obviously these numbers are higher than what they are currently in 2024 and 2025.
Yeah, and look at the now. This chart is not adjusted for inflation. You'll notice that the income levels are based off of 2017. So
Yep.
those income thresholds will be changing. They change mostly every year. They adjust with inflation, but just so understanding that those numbers are different. But the concept here, like Jeff mentioned, your 22 goes to 25, the 24 goes to 28. But look what else happens. The income thresholds, the levels, they change as well. So again, this is using numbers 2017, 77,400 to $165,000 of income is today at a 22% level. Again, when it at the end of next year, if Congress does nothing, all right, that level from $75,900 to $153,100 is at 25%. Well, look what happens if you make $165,000 going back. Let's just say during the 2018 period, you're in a 22% bracket. But if you make $165,000 in 2026 and this Tax Cuts and Jobs Act sunsets
around here,
that's 28%. You went from 22 to 28%.
Yeah. Yeah. So this is where, we talked about, hey, the marginal is your next dollar of what it's going to get taxed at. So again, if that income, if we go back to that example before where we're at 175,000. So if I'm at 175,000, I'm right here paying my 24%, tax rate. But here I'm at 28%. So not only did I pay 3% more in taxes in this income from 75 to 153. But now if I have additional income, right, maybe I have money sitting in a CD or a higher interest bearing account, which are easy to find these days, right? It wasn't an issue back in 2017 and 2018. But now we have many clients that have some of their savings accounts getting 4 or 5%. Now that money is going to just basically get added onto their income. So that's the money that Steve has mentioned that is now going to get taxed at that 28%. So again, not only do we pay 3% more on money above 75,000, but now we're paying, again, upwards of 4 to 6% more on, other dollars.
Great point. No, and if you think about that interest rate, that 4% interest rate, assuming you're in a 20% bracket, that's not really 4%, right? That's actually, if you took 28% of that, because that 4% interest is going to stack on top of any other income. And if you're in the 28% bracket, then that interest income is going to be taxed at 28%. That 4% becomes 2.88%.
Yeah.
At 20%, tax rate. So just to be mindful of that, and to make sure that you're using the right strategies, to make sure that you're making sure you're keeping the most amount of money that in your pocket, right? Your after-tax wealth or your after-tax return.
Yeah. And the again the money is the same, right? So again, if we're looking at this and again the government, especially when it comes to RMDs, is going to force you to take money out at one point, does it really make sense for us to just kind of wait, not do anything, and pay this 28 or 33%? Because again, if your RMDs are even higher, now you're at if you're at $300,000 of income, $300,000 of income, at least you're below, this, you're in the 24% or less. But the next 70,000 above this 233, you have 70K now getting taxed at 33% when it could have got taxed at 24%, right? So again, that's a 9% difference. And that's where again, does it make sense for us to do Roth conversions now and possibly pay 24 to 22% and kind of try to make value of what we have over these next 2 years, rip the Band-Aid off to kind of save us from what might be coming. And again, this is if they do nothing. So again, this podcast episode might get outdated pretty quickly. There's a lot of factors, but that's why again, planning is so important, so you can try to control what you can control.
And I'll kind of leave it at this as well, because we talk a lot about Roth conversions, but we have to think of it in really kind of in two ways. You got the Roth conversions on the the retirement money, we'll call that retirement money that you have, but also for that non-retirement money, making sure that you're using the right investments inside the right accounts so that it grows on the right tax conditions. We're hearing a lot more talk, which is great, of Roth conversions, and that's kind of really what we've seen is becoming more mainstream. But many people who've saved and who are at that point and who are kind of approaching retirement have done a really good job, not only saving in retirement, but saving in their non-retirement accounts. And as kind of Jeff talked about, especially with interest income as an example, right? Whether it's capital gains or dividends, we spoke a little bit about that on previous podcasts, but you really got to make sure you have the right strategy there so you can minimize the tax that you're paying and maximize the wealth that you have, or I should say reduce the tax and increase that wealth, so that so that you're maximizing your hard-earned money and paying less to Uncle Sam.
Yeah. Yep. So we hope that, and again, the marginal tax rate again is what you're paying going forward, right, on that next dollar. Effective, like Steve mentioned, is going to be kind of your average, right? Again, you're going to have some money that's not taxed at all because you had, again, your first 29,000 if you're married, tax free with the standard deduction, and then you had the next 23,000 tax at only 10%, and then tax at 12%. So again, you want to understand, where you're at, tax wise. What else can we kind of cover? I mean, I don't want to feed everyone from a fire hose when it comes to taxes, but again, we kind of wanted to go over the basics here.
I agree. Yeah, because this could get out of hand pretty quickly. We just with different scenarios and really diving deeper into this. But I think that's it. Just the main takeaways is just be mindful of what your marginal rate is. What your effective rate is. A good exercise to do is even if you just grab your last tax return and kind of look at those numbers or speak with the professional that you work with, the advisor that you work with on that. And just to kind of get some clarity around that, I think it's not only is a good exercise, but it's a good eye opener to say, okay, well, wait a minute, if maybe I am at an effective rate, does it make sense not to contribute to 401k? Does it make sense to do certain things to maybe this year pay taxes on it, depending on where you are at in the overall money cycle? I think it's important just to make sure that you're aware, be intentional with that.
Another thing. So again, your effective tax rate, right? If it is 15%, and you're at a stable position in your life where your income is going to be kind of consistent, that's generally what you want to have withheld from your paycheck, or send in estimated tax payments if you're self-employed for whatever reason. A pet peeve of mine is people purposefully and lovingly overpaying in taxes throughout the year, so that they get that tax refund when they file in March or April. Just so that we're all clear, when you go to file your tax returns at in March, April, you're going to reconcile based off the standard deduction. Maybe you have other deductions. Maybe you're in business, whatever the case is. But if you're getting a refund, that just simply means that you overpaid the government throughout the year. And the government is not giving you any interest. There's no bonuses or anything like that. They're just saying, hey, you overpaid last year. Here's your money back. So it would be a lot better if you instead just corrected your withholdings so that money, instead of it being basically an interest-free loan to the IRS, if you just corrected your withholdings, that money would just go to your paycheck throughout the year, and you can have that money to pay off credit card debt or save into an account where you could generate interest. You have the liquidity there. So please, use that effective tax rate to kind of help you forecast what you should be withholding. But just because you're in a 24 or 22% marginal tax bracket, again, does not mean that you have to withhold 22 or 24%, because again, you're not getting taxed at 22 or 24% on all of your money. So please do not give the government interest-free loans. You're not doing yourself any favors. That's my PSA. See everybody.
Yeah, I couldn't agree more. Yeah, otherwise I know Jeff would be more than happy. I think he's created a fund, so if the money.
Before we get into this, I don't want Dustin taking that on from a complaint.
No, all right, I'm just kidding.
No funds.
Edit that one out.
Yeah.
Don't overpay. I agree.
Yeah. But so yes, with check your withholdings. But we hope today's podcast episode was educational. Again, taxes are not as fun as the summer that Steve and I had, and I hope that all of our listeners had. So we appreciate you kind of bearing through this for the last 24, 25 minutes. And again, if there's a certain episode or a certain topic that you would like to hear more about, hear our opinion on, please let us know, and we'll we'll be sure to cover it on the next podcast. Until then, subscribe, listen, and we'll see you on the next episode.
Yeah, I love it. We'll see you soon. Been a pleasure.
All right, guys, take it easy.
Bye-bye.
Thank you for joining us. If you enjoyed our podcast, don't forget to subscribe. We'll see you soon.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. One Team Financial LLC and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through One Team Financial LLC are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.